Good morning. I'm Tim Nyland, Director of Research at Pacific Point Advisors in Rancho Santa Fe, California. Together with my team of analysts, we've built out a state-of-the-art research lab that will bring you a unique and timely perspective of analytical issues of relevance impacting financial markets. Investors continue to wrestle with two sides of the recession debate as it pertains to the inversion of the yield curve on the 2s versus 10s. In one corner, we have the strength of the labor market and consumer resilience causing investors to dial back their recession odds. In the other corner, we have investors pointing to yield spreads at 40-year lows, saying it will not be any different this time. A recession is coming. Unfortunately, we have no crystal ball, so we will explore all sides of the debate and we'll wrap up with what we feel are the three large macroeconomic drivers behind the yield curve recession indicator getting louder. Today's webinar briefly revisits many of the topics we explored in much greater detail in the webinar recorded on October 11th of 2022 titled, "When is the Fed likely to stop raising rates?" This webinar is our most popular webinar to date with almost 1,000 views, and all the concepts still hold true to this day. I would encourage everyone to watch it. It is a great educational piece. You can find it in our research lab on our website at www.pacificpoint.net. Simply access the webinars section of our research lab. You can also go directly to YouTube and search Pacific Point. You can see both locations in the images on the left side of the screen. Simply look for the title, "When is the Fed likely to stop raising rates?" Let's go ahead and get started. The following chart illustrates the 20-year history of the monthly change in non-farm payrolls. Estimates called for 185,000 new jobs to be created for a surprise of 332,000. Three very different takeaways since this report was released, showing 517,000 new jobs were created for the month of January. Equity investors cheered the strength of the labor market by increasing their odds for a soft landing. U.S. corporations with revenue growth and profit margins already under pressure cringed at the thought of having to ramp up layoffs as the Fed holds rates higher for longer to cool an overheated labor market. The bond market priced in greater odds of a recession as the 10-2 Treasury yield spread has collapsed to an 84 basis point inversion since the January jobs report was issued. The following chart illustrates the 75-year history of the U.S. headline unemployment rate, with the current rate of 3.4% unemployment hitting lows not seen since 1969, as evidenced by the red reference line. Investors cannot draw any definitive conclusions from looking at headline rates of unemployment. There's no particular level that says, yes, we're going to have a recession. All we can do is conclude that the labor market is in fact tight relative to historic norms, and that's what the chart shows. The following chart illustrates some encouraging data on the average weekly hours worked, showing a large uptick in January read to 34.7 hours. This most recent read was on average post-COVID and actually above trend in the pre-COVID environment. You can see that post-COVID environment here and that pre-COVID environment here. January also ushered in more positive news in the form of labor force participation rate increase of 60 to 62.4%. The increase in labor force participation can help alleviate wage pressures as the pool of available labor increases. Note that despite the increase and outside of a single read in September of 2015, we are still sitting at labor force participation rate lows not seen since October of 1977. With all the good labor market news, Goldman Sachs did not waste any time cutting their 12-month recession odds from 35% all the way down to 25%. So why has the 10-2 Treasury yield spread collapsed to an 84 basis point inversion, pricing in what has traditionally been considered greater odds of a recession? In a note to clients this week, Goldman Sachs interest rate strategist said that contrary to popular belief, the deeply inverted Treasury yield curve could be signaling that a recession odds are in fact declining, not rising, suggesting that bond traders are making outdated assumptions about things like natural equilibrium level of interest rates in the economy. So perhaps this time things really are different. Only time will tell, but until then, here are three large macroeconomic drivers that we at Pacific Point feel are behind the yield curve recession indicator getting louder, and rightfully so. Driver number one, topic we've talked about a lot lately, U.S. corporate negative operating leverage continuing to drive profit margins down. a trend we have seen accelerating since Q1 of 2022, driven by a decline in labor productivity coupled with high wage growth. Equity investors took the increase in average weekly hours worked at face value without regard for the fact that despite workers working more weekly hours, they are still producing far less output than they were just a year ago relative to wage growth, which remains stubbornly elevated. In the following chart, you can see the 1-year percent change in labor productivity illustrated by the purple line, stuck at record lows, while the 1-year percent change in wage growth remains elevated, illustrated by the green line. Bond investors realize that the strength of the labor market may cause inflation to get sticky, ultimately pressuring the Fed to hold rates higher for longer. The longer the Fed holds rates high, the more profit margins deteriorate, the more likely U.S. corporations are to begin mass layoffs. Once this happens, job losses and fear of job loss dries up consumer spending and triggers an economic recession. Driver number 2, the December JOLTS report released on February 1st showed a rebound in the ratio of job openings to unemployed workers to record high levels nearing 2 seen in early 2022. This is a clear sign of labor market strength, which may ultimately result in wage pressures and sticky inflation. Equity investors failed to acknowledge that the increase in the ratio of job openings to unemployed workers is more than offsetting the increase in the labor force participation rate that everyone got so excited about when it was reported for January. Bond investors realize that the labor market remains much too tight and may ultimately push the Fed funds terminal rate much higher than previously thought, increasing the odds of a recession. Driver number 3, January ISM Services rocked back to expansion territory to 55.2, a surprise of 4.9 versus forecast. This data was overshadowed by the January jobs report released on the same day, but was equally as important. Back in our October webinar, we attributed the bulk of the inflationary pressures to services sector and illustrated the relationship by comparing ISM services sector growth versus ISM manufacturing sector growth. The following chart illustrates the January ISM manufacturing index, representing 12% of U.S. economic activity, in contraction at 47.5, 47.4. While the services sector, representing roughly 80% of U.S. economic activity, bounced back to a strong 55.2. If you recall from our October webinar, ISM Services read of 55.2 means that the Fed will need to stay higher for longer to tame services growth, while the U.S. Conference Board leading economic indicator index is already in contraction at negative 6.03, and you can see that here in the bottom panel. Bond investors realize that the strength in the services sector will require the Fed to continue tightening. At the same time, we have never not had a recession with the U.S. Conference Board leading economic indicator index already down more than 6%. That's about it for today's session. Thank you for attending, and be sure to join us next time.